The third point is multiplying money. Multiplying money is typically your investments that is giving you returns every month, every year, every week, or whatever. Typically, people go for the easiest ones like the government bonds and the stock market. So if you have interest in government bonds, you can always look it up or just search for stockbroking firms online and then send them a message, I'm sure on their Instagram page, and they will be glad to run you through, because you can start with very little from what I have been told. So now I want to take things a step higher for you. I want you to recognize that the inflation varies country to country. If someone in US is getting 10% on their investment every year, their money is making them a lot more money than you that is getting 10% on your money. Let me explain why. The first thing to do when you get an investment opportunity is to check the return on investment on that opportunity versus the inflation in your country. Currently, Nigeria is doing about 17% as our inflation rate. So if you're investing in any opportunity that is giving you anything less than 17%, it means that you just did a savings plan. Your money wasn't able to grow faster than the inflation in your country. Whereas in another person's country, that the inflation rate in their country is 7%, case in point the US, and the return on investment they are getting is 10%, their money has done 3% faster than the inflation rate. So you have to be looking out for opportunities that are higher than your inflation rate in your country. So I'll just be dropping these few points for you to note when going for any investment. You have to know that no matter how high or low the investment returns are, investments are generally risky, and typically the higher the interest, the more the risk, but risk is risk regardless. So investments are not gambling. Warren Buffett would say he has just two laws when it comes to investment. The first one is do not lose your money. The second one is do not forget the first one. Okay, so you have to consider that investments are very risky and you have to be really careful with what you invest in. The second is you cannot invest in opportunities that you do not understand, because if you have a downturn of events, you understand what you got yourself into and you understand the mistakes that you made and how you cannot make those same mistakes in the future. Another amazing point here is you cannot afford to invest with money you are not willing to lose. Yes, it looks contradictory, but you have to know this. If you invest in a business idea or a company or in stocks or what have you, and that money goes down the drain, the company you invested in never went publicly traded, just different scenarios, and you lost that money. If you're going to shed tears for 3 weeks, 3 months down the line, it means that you cannot afford to lose that money. So don't go excited about investing because of the reward and forget that you cannot afford to lose that money. It means that if you have 500k, for example, to invest, you're only going to put 50k in this plan and 50k in that plan, and on and on and on, so that if you lose one of your 50k's, you're like, oh well, I still have 450,000 naira that still has the capacity to grow to XYZ. Okay, that's just the way to look at it. So Professor Adeze is done with a class on financial education 101. If you like this video, please do not forget to give it a thumbs up so that YouTube can recommend this video to other people and I can get more views and this channel will grow happily ever after. If you also want me to share some of the investments that I've been doing in the past 3-4 years down the line, you can send me an email. The email is in the description. I can send it to you. So thank you for watching this week's video. Come back next week. We're going to have fun. I'm going to be giving you the lessons that I've learned in the past 3 months. That's the second quarter of this year. See you next week. Bye.